Let me hit you with a brutal truth. If every job ends in an insurance claim, you're not building, you're firefighting. And eventually, your insurance carrier will notice. So will your bonding agent. And then you're not just managing risk, you're paying extra for the privilege of being labeled a high-risk operation. That's where the insurance claims ratio comes in. It tells you how often your jobs are triggering incidents, accidents, or liability problems before the underwriter does. So what is the insurance claims ratio? Well, it's calculated by taking your claims made, dividing it by your active jobs. So let's just say you had 6 insurance claims filed in a year, and you ran 30 jobs total that year. 6 divided by 30 is 0.2 or 20%. That means 1 in 5 jobs resulted in a claim. And unless you're building on an oil rig, that's a problem. So let me give you a job site analogy. Insurance claims are like job site smoke alarms. 1 might mean someone left the microwave on. 2 or 3, well, that's a fire you haven't contained. 6, you're the arsonist and the adjuster's watching. If every job triggers a claim, property damage, injury, client dispute, water leak, or sub screw up, you're not scaling a business. You're fueling a bonfire of risk and funding your own rate hike. So what is a healthy claims ratio? For most contractors, it should be 0 to 5%. That's excellent. Risk is being managed. If you're between 6 and 10%, you're getting warm and you better watch for patterns. If it's between 11 and 20%, you're in the problem zone. You're trending in the wrong direction. If it's more than 20%, red alert, you become a claim generator, not a contractor. It only takes 1 or 2 years of bad loss history to spike your premiums, limit your coverage, or get you dropped entirely. Let me give you a real contractor example. I had a residential contractor who ran tight schedules and pretty clean crews, but then a foundation crew cracked a neighbor's driveway. A cabinet install damaged a brand new fridge. A ladder slip turned into a workers' comp claim. A painter's drop cloth caused a water line puncture. All within 14 months. His carrier flagged him, and his renewal came up with a 27% premium increase. He lost his affordable general liability policy, and his bid competitiveness went with it. So we dove in. We looked at it. Claims 7, jobs completed 31, claims ratio 22.5%. That's not bad luck. That's a system problem. So we fixed it. We added pre-job site safety checklists. We required certificates of insurance from all subs, updated quarterly. We assigned an in-house quality control role on active sites. We made claims a standing weekly review topic. 12 months later, his claims 1, jobs 34, ratio 2.9. Carrier dropped their rate back down the next renewal. Same builder, safer systems. So how can you reduce your insurance claims ratio? Number 1, start tracking it quarterly, job by job. Know when and why the claims are happening. Number 2, require insurance certificates from all subs. No exceptions. If they're uninsured, you're on the hook. Number 3, create a job site hazard checklist and make your supers use it. Safety doesn't happen by suggestion. It happens by routine. Number 4, do a post-incident review, even for minor claims. 1 incident is a fluke. 2 is a trend. 3 is a process failure. Number 5, tie your claim rates to bonuses and vendor reviews. No incentive, no improvement. So here's the final word. Every claim chips away at your margin, your reputation, and your insurance options. You may not feel it the first time, but by the third, your rates spike. Your bonding gets limited. Your ability to compete vanishes. So ask yourself, are my jobs safe or just lucky? Because in construction, if every job ends in a claim, your business is 1 call away from getting benched by your own carrier.